Hey future millionaires, welcome back to my channel. Today we're diving into the ultimate beginner's guide to wealth through index fund investing. This is to build upon what we last discussed and help you gain clarity on index fund investing. If you've ever dreamt of that magical $1 million milestone, this one's for you. If you watched my last video or are a new investor, you've heard about index fund investing. I promise that it's a simple concept and doesn't require experience in banking or accounting to understand. So for any newbies here, I'd like to first walk you through what it is, how it's done, the risks involved, and all that before sharing how $200 a month will get me $1 million. Are you ready? Index fund investing is like the backbone of investment portfolios. Instead of zeroing in on individual stocks, they roll with a diverse mix of stocks, bonds, and other securities, like assembling a dream team. They're not risk-free, but they tend to be less of a wild ride than going all in on a single stock. Why? Well, it's all about playing it smart and spreading the risk by having a variety of investments in the mix. What makes index funds stand out is that they're on autopilot. No fund manager plays the stock market hero. They simply follow an established index. Less effort, less cost. It's like a reliable sedan of investments, cruising smoothly towards financial goals. There are tons of indexes out there, but the big names are the Dow Jones, Nasdaq 100, and the S&P 500. They're like the A-listers in the US stock market, each with its game plan. You can't throw your cash directly into these indexes, but guess what? Some funds mimic their moves, and you can jump on that train. Here's where it gets interesting: the birth of index funds. They started as the cool kids in mutual funds, but then came the rock stars of the scene, exchange-traded funds, EFTs. They turned the whole index concept up to 11, giving you access to a boatload of indexes and letting you easily craft a sweet portfolio. Take the Fidelity Total Market Index Fund, FSCAX, for instance. Following the Dow Jones US Total Stock Market Index with around 4,000 stocks. And the best part, low fees. We're talking about an ultra-low expense ratio of 0.015%. Now, why do people rave about index funds? Well, picture this. They're not chasing after a handful of stocks like a kid in a candy store. They're grooving to the market index's beats, making them more chill and consistent in the long run. Check out the Fidelity example again. A 1.4% dividend return and a solid 10-year average return of 11.1%. Not too shabby, huh? A few decades ago, the landscape of index funds could be neatly summarized on a single page. However, with the remarkable expansion of the exchange-traded fund industry, surpassing the $10 trillion mark, and the enduring vitality of index mutual funds, the sheer diversity and categories of index funds have evolved to a point where a comprehensive database, rather than a single sheet of paper, is required. While all funds operate on a common principle, tracking the index they profess to follow, the present array of choices for investors is extensive. It encompasses broad market stock funds, comprehensive market bond funds, segments and industries within those markets, thematic variations in the stock market, such as high dividend or low volatility stocks, and an array of alternative investment index funds. Commodities, currencies, and even individual stocks are now offered in index form, predominantly through EFTs. Receiving dividends by an index fund is contingent upon the nature of the target index it emulates. In the case of S&P 500 index funds, for example, dividends are distributed as the S&P 500. As a whole, includes numerous dividend-paying stocks, even though not all individual stocks within the index do. Conversely, indexes focusing on younger growth stocks may comprise companies that do not pay dividends, resulting in the corresponding index funds also abstaining from dividend payouts due to the absence of dividend income from the stocks. Typically, a majority of index funds distribute dividends to their shareholders. Given that these funds mirror specific market indexes such as the S&P 500, they inherently hold a proportional portfolio of stock investments. The frequency often spans quarterly or annually for index funds that pay dividends. Nevertheless, reflecting a trend aligned with investor preferences for monthly income, many exchange-traded funds are adapting to provide monthly dividend payments. An additional feature in certain index funds caters to longer-term investors who don't necessitate immediate dividend payments. In these cases, dividends are automatically reinvested within the fund, contributing to the ongoing growth of compound interest over time. Now, figuring out what you're paying for in index funds is like reading the handbook. in this case the fund's prospectus. The expense ratio is your go-to number, showing most but not all the costs that affect your fund's potential gains. It covers things like paying the folks in charge, the behind-the-scenes admin and legal stuff, and even a bit of marketing. Mutual funds pass on trading costs to you, but they don't spill the beans in the headline expense ratio. You'll find those details in the annual reports or some fancy databases. Now here comes the twist with exchange-traded funds. They have expense ratios too, but since they're the cool kids trading on stock exchanges, you might be slapping some extra cash for transaction fees or commissions when you snag them. Also, watch out for certain mutual fund types. They might slide in some extra fees when you're getting your hands on those shares, either upfront or spread out over a few years. Regarding opinions on fees, it's like a mixed bag. Generally, the fees tend to be low if the index is as plain as your morning coffee. Think S&P 500 index funds, known for having some of the cheapest fees in town. But, and there's always a but, if you're diving into more complex or less liquid indexes, the tricky ones where trading's a bit like a high wire act, those expense ratios might shoot up, maybe hitting the 1% mark. The bottom line, the fancier the investment, the more you might be shelling out, especially when making that initial purchase. Many folks go for index funds thinking they're like the superheroes of investments, you know, the safe bet. But here's the real deal, index funds are only as good as the index they're tagging along with. Now, especially if you're in it for the long haul or just starting, there are some perks to hitching your wagon to index funds. The upsides are: 1. Low fees and costs. They won't be nicking you with hefty charges. 2. You know what you own. Since these funds roll with the index, you've got a daily or at least monthly update on what's in your basket. 3. Diversified portfolio. It's like having a little of everything in your financial picnic basket. 4. Keeping it simple. If you're into the whole set it and forget it vibe for long-term investing, index funds are your go-to. 5. Tax efficiency. They're kinder to your wallet come tax time. The downsides are there too, because there's no such thing as a perfect match, even in investments. They include: 1. Tracking troubles. Sometimes they might not keep up with the index as perfectly as you'd hope. Check that tracking record. 2. Rocky rides. When the market goes bonkers, so do index funds. For example, in 2020 when the S&P 500 took a nosedive, guess what happened to the S&P 500 index funds? Yep, they took a plunge too. So when it comes to index funds, it's like having a reliable sidekick. Cool perks, but not without its quirks. Now that we've covered the nitty-gritty, here's the plan. Remember, this is a journey I'm taking with you. We're starting with a modest $200 a month, aiming for an 8% return per year and projecting the journey over 45 years. Let's crunch the numbers and see how this simple strategy can lead us to that sweet $1 million mark. Alright, let's fire up the investment calculator. With $200 a month and an 8% annual return, after 45 years, you'll be sitting on a cool $1 million. Yes, you heard that right. Patience and consistency are the name of the game. The secret sauce here is index fund investing. We're letting the power of compound interest work its magic, and keeping it simple with low-cost index funds. No need to stress about picking individual stocks, just set it, forget it, and watch your money grow. Index funds are like the unsung heroes of wealth building. They track the market's performance, offering diversification and stability. Plus, with an 8% annual return, you're not just growing your initial investment, you're earning returns on those returns, compounding your wealth over time. Now let's take a peek at our financial projections. Month after month, year after year, that $200 investment snowballs. It's a slow burn, but that's the beauty of it. Time is on your side. Index fund investing is a powerful tool whether you're just starting or looking to level up your investment game. It's about setting realistic goals, staying consistent, and letting time do its thing. So there you have it, a beginner's guide to becoming a millionaire through index fund investing. A bit of a disclaimer though, this is not financial advice. These are only the lessons I've learned in my journey. If you found this helpful, please smash that like button and subscribe for more financial wisdom. Until next time, happy investing on your journey to $1 million.